Hi, everyone. Welcome. Thank you for joining us today for our DIY Investing to Build Wealth workshop. And we are happy that you all made the time for this today. This is one of our favorite workshops. I say that about all of them. I like all of them, but I really like the DIY investing workshop because a lot of the questions I get as a coach relate to where should I be putting my money and am I doing the right things? I don't really know where to start. So this I think is a really helpful, informative workshop to get your feet wet with investing, or if you already are investing, to kind of know what other options there are out there and to just connect with your coaches to learn more. So with that said, we'll go ahead and get started. So to introduce ourselves today, my name is Kimberly Essie. I'm a financial coach at Questus. I'm also an accredited financial counselor. I'm really happy to be joining you all today. And I also am really excited to have one of our newest coaches joining us today. I'll let Sean introduce himself.
Hey, good morning, everyone. My name is Sean Brigham, also a accredited financial counselor here with Questus. Glad to be here and maybe hopefully answer and alleviate any questions and fears you may have about investing.
Thanks, Sean. So just a housekeeping note, we do have a Q&A function that's on, so you can ask an anonymous question there. You can also, it doesn't have to be anonymous, but if you'd like it to be, you can ask a question in the Q&A there. We will get to it as we can. We may do it as we go along or wait till the end, so just stay tuned for us to be able to have a chance to answer your question. Also, if you would like to ask questions in the chat, those are public, so just know that you're welcome to ask questions there or comments, but other attendees will see those. So feel free to add your questions or comments to the chat and Q&A anytime. We'll make sure to get to them. And so for today's agenda, we have a lot that we're going to talk about today. We're going to make sure we cover the basics. If you have more specific questions, again, we'll try to answer them, but also you're always welcome to book a coaching session for your more specific questions or needs, and we'll provide some details on how to do that at the end of the workshop. So we're going to talk a little bit about why investing can be helpful to you, why so many people do invest. So what are the reasons people do that? Basic concepts and strategies around investing, investing outside your retirement plans and within your plans. So that's usually where people first get their feet wet with investing, is through workplace retirement plans, but we'll talk about the various ways that you can be investing. And then we're also going to create our own investment strategy, or at least talk about the ways in which you can create your own investment strategy. And with that said, we'll go on to the next slide.
All right, so just a quick question to start us out. Of you all, how many of you think of yourself as an actual investor? Just a show of hands, show of hands this way, or put in the chat, or raise your hand virtually. Just how many of you think of yourself as an actual investor?
Oh, nice. Quite a few. Great.
All right, so guess what? So those of you that did not raise your hand, you too might actually be an investor, just don't know it. So think about it. Do you have a 401k account at your job? All right. Even though you may not be a day trader, so some of you may have thought day trader when I asked who was an investor. That doesn't mean you are just picking individual stocks. So if you actually have a 401k at your job, or a 403b, depending on just any type of retirement account that your employer offers, you are an investor.
Yeah, I always think it's really interesting to think about it that way, because when I just had a workplace retirement plan, I would never have called myself an investor because it didn't feel like I was doing a lot of hands-on investing, but I was in the stock market, right? I was I was in a place where I was investing money. So now I feel comfortable saying that, but it's very interesting to think about it in those terms, right? So for those that are not investors, or maybe there's more that are investors than we initially thought, but why be an investor? So it can be kind of scary too, when you aren't really familiar with what investing can look like, or you maybe are only in a retirement plan and you're not doing a ton of like hands-on kind of active investing. It's kind of scary to think about doing that or where to even start. So a lot of people just don't, or they say, "Well, I'll do that another day," or "I'll talk to a professional," and that day doesn't come. And all the while, the time in the market is being delayed and delayed. So why should you be an investor if you're not already? Well, you can't save your way to retirement. Now, that's not completely true. If you have a large, hefty sum of money sitting in a high yield savings account, you may know that at 4 to 5% interest currently in some of those high yield savings accounts, you could make a pretty sizable portion of money on just interest alone. But generally speaking, that's not how people are growing their wealth. And how do you get such a large sum in the first place to be able to make that kind of money, that kind of passive interest? You probably invested it unless you're just independently wealthy or have a trust fund or whatever the case may be. So oftentimes saving alone is not the way to have enough money to retire or to kind of grow your money for other goals you might have. And even though interest is kind of high right now on high yield savings accounts, standard savings accounts at your standard brick and mortar bank are under 1% still. And you can compare that to the average stock market return tracking the S&P 500 index, which is 10% per year. Now, it's of course not going to be 10% per year, but that's the average. So some years are going to be great and some aren't so great, but that average is 10%. And last time I checked, there's no high yield savings account earning 10%. So, of course, there's always a reason to have savings. And we are going to talk about savings versus investing and how they can both play a role in your portfolio. But it's just something to note that if you're too concerned about kind of risks or ebbs and flows of the stock market, you're still missing out on that average 10% per year potentially. Now, you probably can't live on Social Security alone, but again, you could, and we are going to talk a little bit about what that might look like. But for the most part, Social Security is probably a part of your strategy for retirement. It's going to provide a buffer and kind of fill in some gaps, but it may not cover your full retirement. And so investing is one way to bridge that gap and get those kind of longer term returns with time in the market, 10% a year average. It's kind of Social Security has always been meant to be a buffer, but not necessarily the full amount of money you would need. And historically, investing is a tried and true way to grow money over time. We're going to show you a graph that I find fascinating. And I was searching for graphs that show this, and all of them show this really beautiful trajectory. So, Sean, would you like to show them that graph?
Let's take a look at that graph. All right, so as we look at this graph, notice this is a 200-year graph here. As we look at it, we notice this graph has an upward trajectory. So it's always headed upwards. Now, if you look closely in between or, get in real close to the dates, you see ups and downs. All right, that's expected. That's how the market works. There are always ups and downs, but the overall path of the market is always upwards. All right, because if we want to look closely, just like yesterday, market was down yesterday. So if you want to look at it from day to day, which I do not recommend, yeah, you're going to see downs and ups. Some days real low, some days real high. Like yesterday was a real low day. So you may not feel so great if you were looking at the stock market yesterday. But overall, like if you change it from a day look to a week or a month look to a year look, you'll see that, hey, this market is upwards. All right. And so just like here on this 200-year chart, you'll see that the market has gone way up. So remember, investing is not a day-to-day thinking habit. You have to look at investing as long term. All right. So as you look at this graph here, you'll see over the long term, if you put the money in your stocks and investing, it has gone up. All right. So that's what we want to think about when we think of investing long term.
Exactly. Yeah, and I just think this is such a great visual for that. I always think about I read a quote. I'm trying to think of the exact quote, but the only sale that we don't like is when stocks go on sale because it means the markets are down. But if you think about it as, oh, they're on sale, I mean, that's a different perspective when you think about dips in the stock market. People may fear it, but it's also an opportunity to get things at a cheaper price than you might otherwise. And so that's an interesting take, I think, on investing long term. So let's talk a little about savings and investing. And I want to talk about how both of them can be beneficial to your portfolio. And we'll talk a little bit about diversification. There's many ways that you should think about diversification. And one of them is considering investing and savings together. So savings and investment accounts both help you be diversified in the types of things that your money is going toward. Savings is necessary for having access to liquid cash. And as coaches, we talk a lot about emergency funds, having some cash for a rainy day or a sinking fund, money that if you needed it today or tomorrow, you would be able to easily have access to. Now, the benefits of having easy access to money is that you're not taking any risks with that money, which means that your return is going to be lower. So interest rates reflect that. So your savings interest rate, while it may be higher than it's been in a long time in the last couple years because the federal funds rate has been high. So your savings is making more money, but generally speaking, savings and interest rates on your savings are going to make less than the average rate of return of the average, that 10% average that I shared with you. But the payoff is that now you have that liquid cash that's safe if you need it. There's no risk involved if it's at a bank or a credit union that's FDIC insured for banks and NCUA insured for credit unions, up to $250,000 per account. So that's a great place to keep money that you need safe, that you need for shorter term goals, maybe a down payment on a car or a house. You have a wedding coming up, you are looking at college costs. There's a lot of reasons you'll want that money. And it's always a good idea to have cash in your portfolio for these kinds of emergencies and also to make a little bit of money on that interest. But also, the interest rates can vary for many reasons. And I wanted to talk a little bit about the difference between interest rates and rates of return. So when we talk about interest rates, we're really talking about savings accounts, liquid cash, could be CDs. CDs are similar to being cash. And if you're familiar with CDs or certificates of deposit, you might be earning a slightly higher interest rate than a high yield savings account. But the trade off is that your money is tied up for a certain maturity that you choose. And you aren't necessarily going to have access to that money within that period of time. Or but you might take a ding to the earnings that you'll make on that CD. So these rates are impacted by factors like a financial institution's appetite or lack thereof for cash deposits. So when we think about banks wanting money, it seems natural for us to think that they would want you to have your money there, and interest rates will reflect that. But not all banks want your money. And so some of the banks that are paying you 0.25% interest probably don't have a huge appetite for cash and cash deposits. They might send their money overnight to another bank and then it gets sent back. That's the overnight or the federal funds rate, which we'll talk about in a moment. But not all banks want your cash all the time. And so interest rates that you're seeing at different banks are going to reflect that appetite. The federal funds rate, which I mentioned, you've probably heard of this. This is what the Fed discusses and determines as part of economic policy. And this guides the lending rate, overnight lending rate that US banks charge and pay each other to hold large balances. So this is going to be currently around 5.25 to 5%, 5.5%. You might notice that your interest rate at a high yield savings account is lower because they want to make some money. They don't want to give you all of that interest rate. So the federal funds rate is a guide, but what you're actually making on your accounts is probably going to be a little lower. Demand for treasuries, this is bonds, so treasury bonds. This also has to do with federal, the Fed and economic policy. And we don't really need to talk too much about this now. But if you do have questions about how treasuries and bonds affect your interest rate, happy to talk about that offline. Or if you have a question, you can ask. But this demand for treasuries is reflective of confidence in the economy and inflation. And so this is a guide for also knowing what interest rates might be, or if the economy needs to be cooled, or if it's too hot, or if it's not hot enough. You'll see treasury bond yields change to reflect that confidence. Now, overhead costs of institutions. This is where brick and mortar versus online banks come in. A lot of the high yield savings accounts with the 4 to 5% yields or interest rates are banks that don't have a brick and mortar location. And so they don't have the overhead costs associated with having a bunch of branches and a lot of ATM machines. So they're able to pay higher interest rates. They can be more competitive there. Of course, the negatives is that you don't have a bank you can go to, and you don't necessarily have a dedicated ATM. So there's the pros and cons of brick and mortars versus the online banks. And then rates that competitors are charging for interest. So if one bank raises its rate to pay you 4% for your balance, the other one might say, well, I want that money, so I'm going to charge 4.25. And so that's also playing a role in competing for your deposits. Now, when we think of investing and rates of return, these are in fact impacted by much different, very different things. And because investing is often stocks, which are connected to companies, the underlying factors that are impacting your rate of return are a little different. So we're looking at the type of investment that you're in. So let's say you're in an index fund. A lot of 401ks and 403bs have index funds that you can invest in. The index funds are going to be indexed against, let's say, very large companies or medium-sized companies or small companies. And they're all going to hold different percentages of stocks in those companies. And it's a broad list of companies. So it's very diversified within those categories. But that type of investment might be a lower risk. So you might have a lower rate of return. You might be making less profit off of those kinds of investments as opposed to something that's maybe, let's say, based on commodities. Maybe it's a Bitcoin fund, or it's a gold fund. These things are a lot more volatile because they're not as diversified, but your rate of return might be higher, but your risk is higher. So the type of investment really impacts the rate of return you're going to get. The asset mix of investment relates exactly to that. What kind of assets are within the investment? A target rate fund, which is very common, a target date fund, which is very common in a retirement plan, those are going to have an asset mix of investment that changes over time. So you're going to have maybe 80% stocks and 20% bond funds. And as you get closer to retirement, it'll change to being less stocks, more bonds. And so that's going to change the rate of return as you move into something less risky or more risky. The strategy and operations of not just the investment brokerage where the fund is held, but also within the fund, what the companies where with the stocks, like how they're managing their strategy and operations. So that's kind of multifaceted, of course, but that will affect your rate of return. Perceived or inherent risk. So this can be kind of more relating to stocks individually. So if there's a particular stock that you've been watching in your portfolio that's just, or you're hearing it in the headline in the news all the time, and it's going up and down and it's wreaking havoc on your portfolio, that is probably because there's headlines that are bringing it to people's attention and they're perceiving a risk in that, or they're concerned about it, or there is an actual risk. There's an underlying issue that that company is experiencing. Will they get over that issue? Will they be able to change management, or change the way they operate, or is it just going to be volatile because no one knows their next move? So perceived and inherent risk can affect your rate of return. The regulatory environment. This is very true of cryptocurrencies currently because they're not necessarily regulated, but they could be. And the fact that they're now becoming part of index, or they're part of funds, there's mutual funds that do cryptocurrency, is a step toward that more regulation type of thing. So we're seeing it less as a currency and more as an investment, which means it may be regulated as an investment in the future. And we're already kind of moving toward that. So that can change the rate of return. It becomes maybe less risky, more risky. The liquidity of the investment. How easy is it to get out of it? Is your money stuck there? Are you able to easily sell that investment and get your money and leave that market, or not? What are the costs and benefits of alternatives? So in this case, I'm thinking of a savings account. So if you're getting, let's say, 2% on your bond fund, but your savings rate's 4%, that might make you want to leave your bond fund, right? Like you might be looking at the savings rate and saying, well, that's more than I'm getting in the stock market, even though it's bonds. But if the cost and benefit of alternatives for you outweighs that investment, then maybe that's not worth it to you. And maybe other people feel the same and they're going to leave that investment as well. You'll see the price fall. You'll see your rate of return fall. It's kind of like a domino effect, if you will. And that also goes along with the last point: buying, selling, and speculation. So if something is speculative, if people are going in and buying something with the intent to sell it the next day, you're going to see some very volatile rates of return, and that's going to in fact affect your personal rate of return for that investment. I know that was a lot. Thanks for bearing with me. All right. So Sean, I know we mentioned Social Security without investment or savings. I wanted to go back to that in our next slide and maybe have you cover a little bit about what that could look like and how investments could bridge that gap potentially.
All right. So everyone here, if you look at your paycheck stub, you probably have a direct deposit and don't ever really go back and look at the paycheck stub, except for when maybe you first started working to see what I was taking out. But if you go back and just log into your account, pull up your paycheck stub and look at it and see what all has actually been taken out, you'll see that, hey, Social Security has been taken out for you. Now, Social Security was meant to try to help alleviate retirement. But a lot of folks think that, hey, Social Security will be there. That's all I need. But if we look at this, it's not really something that you want to depend on as a sole account for retirement. Because the average here, as you see, is around 1,700. Don't know about you all, but I'm not living off $1,700 a month. Some of you may be able to pull it off. If you can, that's all great. But for the most of Americans, I don't believe $1,700 a month is going to get it. All right, so that's why we need to look at other things other than Social Security. Now, Social Security will be there to help, bridge some of that gap, but it's not something to depend on solely. All right, because I've got an uncle myself who refuses to look at investments, and he thinks that he's going to be able to just live off Social Security. We're going to have some more talks with him. All right, so hopefully that's not going to be you. But when you see Social Security, $1,700 a month. If you look at some of your expenses, your mortgage or rent's probably more than $1,700 a month. So if you're working currently now, making more than $1,700 and struggling, do you really think you're going to be able to live off just $1,700 during retirement? Chances of that are no. Even if your expenses are lower than what they currently are, inflation's still out there. You still have to eat. You still have, even though you may have, Medicare, Medicaid, those still have some cost to it. All right. Some folks will say, hey, maybe it says wait till 70 years of age and you get that 8% boost. Who wants to wait till 70? You're already working towards retirement. You're not going to sit there and wait till 70 to enjoy life. You want to enjoy life sooner than that. So that's why we don't need to be relying just on solely Social Security. And some folks also think they'll just relocate, all right, or downsize. Okay, yes, you can downsize that nice big house you may be in, but that's only going to alleviate maybe the mortgage. You still have your heating, your food, all your basic living expenses. All right, so that's why we say, do not rely on solely Social Security. Use that as something to help with all the other investments that you're going to be doing, but no, do not rely on it solely. All right. All right. So next, we're going to look at the differences in how saving and investing can compare. All right. So some of you may just be saving, but as we saw earlier, a lot of you are investing as well. Now, this chart here looks at the basics or comparison of what it looks like of someone that just saved versus someone who actually invested. Now, with this chart, we're looking at averages. So we're going to say that with this example here, the savings is at a 2%. Now, in today's time, that's actually pretty generous, unless you're looking at those CDs that they're throwing out around now. Some companies or banks are having like a CD for 4 or 5%, but if you look at their actual savings accounts, those are less than 1% right now. So even with this 2% that we're using, that's pretty generous. All right, and for the investing, we're going with the average of about 7%. Now, some folks may get higher, some may get lower, but we'll look at the average. So if we start out with 50,000 and we just invest $1,000 a month over 30 years. So at the end of that 30 years, you're looking at with the person that only saved and got 2%, they got $584,000 versus the person that put that same money in investing and got 7%, they got 1.6 million. Don't know which about you, but I think I'd rather have that 1.6 million. All right. Same amount of money, just what you should do with it. All right. You are out there working, going to work every day. You also want to make sure your money is working. All right. You don't want to be the person sitting next to, that employee that's not working as hard as you. Well, think about your money. You don't want your money to be, hey, that person that's not working as hard. You want your money to be the person that's going above and beyond. So going above and beyond would be putting that money in investing. All right, not saving. Of course, you still want some saving, but not just all saving. All right. So as you see, the person that invested had almost like 3 times as much than the person that just did basic savings. All right, so we want a nice mix, but don't just do just completely savings. Otherwise, you will end up with not nearly as much money as you possibly could. And of course, for retirement, we want to sit back, relax, have fun, go on trips, and do things. In order to do that, you've got to use the right vehicles. All right, because remember, we're all headed towards the same direction, which is retirement. We just need to make sure we use the different categories and vehicles and things to get us there. It's kind of like a math problem. You know the right answer, but Johnny may have used a different formula than I used, but we got there at the same way. All right. So investing has different options to do. Just you pick one that you feel comfortable with and get to that end goal of retirement.
Yeah, great. I totally agree with that, and I really like the way you discussed it, because I just think too that when we're thinking about the trade-off, we don't it's just hard to see in the now when we're looking at this as a 2% savings rate at a 4%, we're just thinking there's really way less risk doing it this way. Why would I get a few more percentage points to just have more risk? But this shows what a few more percentage points will do, right? So thank you for sharing that. So really a combination of multiple income streams is really what we're aiming for. As coaches, we often meet with clients who they know that, hey, I am going to need multiple income streams. I'm looking at what my expenses are, even if I were to pay off my house before I retire, even if I downsize, which these days with interest rates being what they are, may not actually be cheaper. uh, so having a combination of multiple income streams, including Social Security and possibly savings, but maybe pensions and investments, of course, can provide that diversification also of income streams in the future. So if one goes down a little, then it's not going to affect your whole income because you have other streams that are coming in. So let's talk briefly about being an investor versus a trader. I know we kind of discussed this, Sean mentioned it. Both are valid ways of investing, but because what we're talking about is long-term investing in this workshop, really we want to talk about being an investor rather than a trader. And really the difference, and you can do both, but being a trader is more tr- less long-term and more short-term gain, where someone might be in the market to make a quick buck. There's likely to be high risk and the possibility of high reward. That's not to say that long-term investing can't be high risk and high reward as well. In fact, a lot of investments are high risk, high reward. But again, that depends on your risk tolerance, which we're going to talk about. But really, when we think about investing, we're thinking about putting resources down today with the expectation of that growth in the future. So we're always thinking kind of longer term future. Longer term doesn't have to be 30 or 40 years, though. It can also just be 5 years, it can be 10 years. It depends on what your goals are. Maybe you're close to retirement. Maybe you want to invest because of some other thing besides retirement. There's a lot of reasons that people would want to grow their money beyond that savings rate. And there's also a lot of reasons why trading would be kind of an okay thing for one person and not for someone else. So also, when we talk about trading, I do have speculation here, speculative trading. If you're in a situation where it feels like a gamble to be investing in something and you're not comfortable with it, it could be speculative. It might not be right for you. It all depends on your risk tolerance. But just to keep in mind that if something is a really high rate of return, it probably does have substantial risk, or there could be a lack of liquidity. It could be that you're not going to be able to easily sell that investment. So a coach is a really good person to kind of bounce these ideas off of with pros and cons of different investments. But an investment an advisor could also be a really good person to talk to if you're really trying to think about more specific things to invest in. As coaches, we don't really talk about those things, but we do just like to give information about investments in general. So let's move on to not the next slide, but the following slide. And that's going to be styles of investing. So let's briefly talk about different kinds of investing before we move into retirement and non-retirement investing. So different types of investing include cash, which we've talked about. That could be savings accounts. It can also be CDs, which are similar to cash equivalents. Something that you might have heard of called a money market account. That's going to be, let's say you open an investing account at a brokerage and your money is in a money market account until you invest it. That's all kind of considered cash. There's also bonds. And so bonds you can consider them as debt. So the idea is that some entity has taken, is needing to borrow money and you are their lender. So you are funding their debt by buying bonds with the promise of a certain amount of money in the future for holding it to a certain maturity. Stocks are another type of asset, and this is actually equity. So you're a shareholder in that company. You own a piece of that company. You may have voting rights, and you may be receiving dividends for holding that stock. So those are the different ways that you can have assets. And those are just kind of the basics. Asset allocation is on a spectrum. We've talked about risk, we've talked about less risk. So conservative would be somebody who is not wanting to have a lot of money in the stock market, or who is okay with some money in the stock market, but wants a really, really safe type of low risk investment. So the rate of returns are going to probably be lower versus someone who's more aggressive and everything in between. Aggressive might look like a very high rate of return, but high risk companies, or maybe not a ton of companies that they're invested in. Maybe they're in just some commodities like gold or energy or oil. They don't have a lot of diversification. Aggressive can look like a lot of different things. So those are just some examples. There's also passive versus active investing. Think of passive investing as your 401k. That is or 403b. That's very passive. So there's going to be a very limited number of types of investments you can get into within a plan. And you just put your money there, and it's managed by the mutual fund manager. You're paying them a fee to do that, but they're kind of you're not involved in the actual buying and selling of things within that. Someone else is doing that. Active would be more like you're buying stocks. You're out in the world saying, I like this index fund. I'm going to try to recreate it. And this is for more advanced investing. You can dip your feet in it at any time, but it's definitely more of an active thing because you're going to need to be monitoring your investments a lot more. It can also, passive and active can also be a feature of a mutual fund. So that's a little confusing maybe. Some mutual funds you're in are active, meaning that the fund manager is doing a lot of buying and selling, and that can impact um, taxes if it's in a taxable account. And then a more passive fund might not require as much activity by the fund manager. An example of a more actively managed fund would be a target date retirement fund because over time those get more conservative. So your fund manager is probably going to be doing a little bit more buying and selling over time. And the fees that they charge reflect that. So when you're looking at your investment options, fees do come into play as far as the kind of how much is being done by that fund manager. Common types of investments include, we've talked about stocks, bonds, mutual funds, index funds. These are all kind of buckets of stocks or bonds. Lots of companies, so they're generally diversified unless they're in a specific kind of industry. There's exchange traded funds, which are basically, think of them as mutual funds, but stocks that you can buy and sell in real time. Options, commodities, we're not going to go into that too much, but if you have questions, let me know. And then real estate, which is very illiquid, but lots of people do invest in real estate or real estate in REITs. I'm spacing on REIT, but those are like mutual stocks. They're like stocks that are real estate related. So you can kind of own real estate through a REIT. Also kind of a more complicated asset. We don't need to talk about it, but if you're interested in learning more, you can always talk to a coach. Okay. We'll briefly go over this next slide. So thinking of investment accounts as containers is really helpful because when you open an investment account, it is simply a container to then put money into and then invest it. So putting money into a 401k or a 403b is just putting the money into the container. From there, you have to then invest it. So I've met with clients who weren't sure why their rate of return was so low. And we looked in it and realized they didn't actually go in and invest any of the money. It was sitting in like the money market account. So you have to direct that money within the containers. The containers can be very different. They're taxed differently. So a 401k traditional, which means pre-tax money's gone in, that's going to be taxed differently than a Roth 401k, which is post-tax. A savings account is going to be taxed differently than an investment account, and so on. So it's important to know that the accounts are just containers. You have to then go in and do something and direct that money to where you want it to go. But one of the nice things about that is you can always change your mind. You can invest in something different if you're not comfortable with something. You have the capability to adjust your investments to your risk tolerance. There's different rules about availability. So again, this kind of relates to an investment account for retirement versus an investment account that's not a retirement account. You're not going to really have access to your 401k in the same way that you're going to have access to even your own Roth, IRA that you've opened, or a savings account, or your own investment account. They're all going to have different access levels. Um, it may function differently. It has a different purpose. It may be more or less available to you liquid. And so having a lot of different kinds of containers with different types of things in them can often mean you're more diversified. So, yeah, I think that's all I wanted to say on that. Okay. Sean, do you want to go ahead and talk a little bit about becoming an investor outside your workplace plan?
All right, so put an investor outside. Reasons, there are different reasons why you might want to become an investor outside of work. But first of all, make sure you take care of what the work offers you. Remember, a lot of your investment accounts that the work offers you, they offer a match. All right, that's free money. So if they say like, hey, if you put in 5,000, we'll put in 5,000. All right. So whatever the match is, a lot of times it goes up to 5. Different companies offer different matches, but whatever, check with your HR company, not HR company, but check with the HR department of your company and see, hey, what does our company offer as a match? All right. And you always want to at least make sure you're putting in the match, because that is, like I said, free money that they're going to give. So if you put it in, the company will put it in. All right. At least go up to the company match. All right. And then outside of what the company offers, you may want to do some different investing on your own. All right. Because maybe the company's retirement plan doesn't allow you to pick individual stocks, or maybe it's not the portfolio or different mutual funds and things you want, or just for any reason that may have certain limitations on what you're able to do. And so you may want to also add in an extra investing outside on your own of what your company will offer. All right. So, but before you do that, a couple of things you want to look at before, excuse me, before you do that. The first thing is make sure you have an emergency fund. All right. So before we start doing any investing, we want to make sure we got basics for home covered. All right. Anything can happen. Storms, layoffs, anything. Just they say prepare for a rainy day. All right, rainy days are coming, whether you want them to or not. Always prepare for that rainy day. So have an emergency fund where you got 3 to 6 months of living expenses set aside, so that when that rainy day does come, not if but when, you got money set aside, and because you don't want to dip into your retirement account. All right, because remember, the retirement account is for retirement, not oops, something happened right now. So set aside something, like I said, an emergency fund for those oops, uh-ohs that are bound to happen. All right, and the other thing that you want to look at is take a look at those credit cards. All right, do you have those high balances on those credit cards? Because you might want to look at those interest rates you're paying on those credit cards. All right, so you can actually earn a lot more money by paying off those 19 to 29% interest rate credit cards than investing. Because if the credit card is charging you 29%, but the stock market may be giving you 7 to 10% right now, you're gonna actually be making more by paying off a little bit on those credit cards. So those are, like I said, two things to look at before you start looking outside for extra investments. All right, let's say the emergency fund and the credit cards. All right, next up, let's look at some different choices you have for looking outside. All right, so one of the first things are, like Ms. Kim was talking about, was the differences in being taxed before or after. All right, so like your 401k plan that you may have at your job, they take that money out before you see it. And so it means it's not being taxed right now. So it means when you actually do get ready to use it, Uncle Sam's going to want his cut. Uncle Sam's going to always get his cut, whether it's in the beginning or in the end. All right. So an alternative to knowing that. So if you're trying to, like I said, people do different things for different tax reasons. All right. So a different option outside of looking at, account will be Roth IRA. So with a Roth IRA, what that is it's just like she said, Ms. Kim said, with different buckets. This is just another bucket that contain your investments. But with this, you're using this with money you've already paid taxes on. So this is where you've got your paycheck. You Uncle Sam, everyone's already took out all theirs. This is what's left for you. And now you can still take this money now that you've already been taxed on and use it for investments inside a Roth IRA. And no matter what that grows to, guess what? You've already paid the taxes on it. So when you get ready to take that money out, all that's tax free. Right? You've already paid the taxes. So you could put in, like I said, maybe $10,000 over that time and it grows to, 50,000 or even higher. But whatever it grows to, you paid taxes on it in the beginning. So whatever it grows to in the end at 50,000, 100,000, you get that when you get ready to use it, that comes tax free because you paid Uncle Sam up front. All right. So that's a good mix to have of, hey, money I paid in, investments that I've done like 401k that, where you have them taxed differently, right? Because some people may want to pay taxes now, some may want to pay taxes later. Think about it in this way. Like I say, Uncle Sam's going to get his regardless. Now, do you want to pay it now or later? Some people may think, hey, I'm going to probably not make as much money now. I intend to be in a higher tax bracket later. So I think I might want to pay some taxes now instead of having to pay it later when I'm in a higher tax bracket. All right. And some people may be like, hey, you know what? I think I want to get some of these taxes done now so that maybe I can lower my tax bill. So it's different strategies. Like I say, you talk to your tax advisor or investment advisor as to why, which will be best for you. Like I say, do a mix. But like I said, there are different reasons why people will choose to do an investments where it's taxed before or after. But the investing is all the same, whether you invest in a stock with before tax money or invest in that same stock with after tax money. That doesn't change of how you invest. The only difference is hey, when am I going to be taxed? All right, those are the difference in like the containers there. All right, and then like I said, what goes in those different containers? Like I said, you got CDs, bonds, mutual funds, ETFs. Like I said before, the CDs and bonds, those are going to be lower interest because they are less risky. So the less risk, the less interest. The more risky something is, the more interest you'll earn. All right, mutual funds and ETFs, those are kind of like sister investments. What those are, instead of you investing in individual stocks, like I want to buy Apple or I want to buy Facebook, instead of putting all that money into individual stocks that may go up and down, take a big dip, these mutual funds and ETFs, they do is they invest in several of those stocks, several pieces of it. So instead of having a whole one stock of something, I may have 5% of this stock, 5% of that stock, 10% of this stock, just a whole big pile of stocks into one. So that way, like I said, if you invested $1,000, it's safer to have $1,000 invested in several stocks instead of just that one stock. All right, so that one stock could take a dive and you lost everything. Whereas if in that mutual fund, if that one stock is inside of it, if it took a dive, you've got all these several other mutual funds to help pull it back up. All right, so think about that when you're investing. If you want to have some fun and do some individual stocks, that's fine, but don't do too much. I would say in individual, most of your money should probably be in mutual funds and ETFs so that you have a wide range of investments. All right.
Okay, so we did talk a little bit about this, so we'll breeze through this slide and the next one. We're just going to talk about making the most of your workplace retirement plan. And this is also part of investing outside of your workplace plan. We talked a little bit about that. One thing I do want to mention about index investing and dividend investing is they're very different approaches to investing. And the thing to kind of know the difference between the two is that with an index fund, it is diversified within the fund. So if you're looking at an index fund, it's going to be an index of a certain let's say S&P 500 index, or it could be an index of tech companies. It could be an index of blue chip companies. It could be an index of any kind of like industry. And so you're not picking the stocks themselves, and the investments within those could yield dividends or not. Many companies don't have dividends. That doesn't necessarily mean they're not in that portfolio. When you're looking at like dividend investing, for example, those are going to be stocks that pay a dividend. And so people that are doing that are actually going in and picking dividends or dividend stocks, and they're holding stocks. So there's less diversification unless you are buying a diversified group of stocks that, you're looking at an index fund and saying that that index fund has 50 companies. I want to go in and own all those 50 companies myself that have dividends. That's a different approach. I've seen both, and I think that they both have pros and cons, but the dividend investing is definitely more hands-on. But that said, there are index funds that are dividend appreciation funds and things like that that you can find. So there's a lot of different options out there. And I think that's my main point is, once you start kind of researching what's all out there, it's about knowing what your risk tolerance is. It's about knowing how much you want to learn and be hands-on with your investments. It's how much you want to just have someone else do it and you'll pay a fee for that. So I just wanted to bring that to everyone's attention because it's a big world of investing and it can be confusing, but um, coaches are here to help you understand the basics. Investment advisors can help you specifically choose what's best for you and your risk tolerance in your portfolio. Okay, so let's move on to the next slide we've kind of talked about. So I don't want to spend too much time on this as we get closer to the hour. But we did talk a little bit about this when Sean was talking about traditional versus Roth. There's a lot of reasons why you might choose one or the other. The pros and cons are there's a lot of pros and cons, and what is best for you is going to be unique for you. So this is another thing where I'd say coaching sessions can be helpful because you can talk about your own situation with a coach. But we did talk a little bit about target date funds and mutual funds. Those are going to be what you're going to see in a workplace plan. When you're investing outside of a workplace plan, you'll see that there's a lot more options. So that can be good and bad. If you're having choice overload, which is a thing, then that might be a little stressful. And so if you're investing outside of your workplace plan, that can be a little stressful, but I think it's a good guide to look at what's in your workplace plan and say, well, what do I like there? And where, what would I like to replicate that? Do I want to do something different? So that's something to keep in mind when you're thinking about your diversification outside of a workplace plan. And it can also be good to have a good mix of workplace plan accounts, personal retirement accounts. I mentioned an IRA, individual retirement account. You can open those yourself. I could go on about that, but I won't. So lots of really good options for the containers you can use. It's all about what you want to put in those containers. So let's move on to what you can do today. Sean, would you like to talk about that?
All right, yeah. So we actually did kind of talk about this earlier when I told you talk with your HR department. All right, go see, hey, what does our company actually offer? All right, how much are they offering as a match? This is something you actually want to make sure you look at and see, because remember, that is free money. The company is actually going to match what you put in. Think about it like when if you got kids, or when you were a kid and your parents said, hey, yes, if you save up so much, I'll match it for you. All right, like my mom does this something for like the grandkids. She tells them, hey, whatever you save up for a car, we'll match it. All right, that's kind of like how your employer 401k is. Whatever you put in, we're going to match it, but only up to a certain point. All right, so you can't put in 20,000, expect the company to put in 20,000. Their match may only be up to 5. So if you put in 20, they'll still put up to their 5. All right, but if you only put in 3 and they're offering 5, you just missed out on an extra $2,000 that the company was going to give you for free. So always try to at least put in what the company is going to match you with. All right, so that's very important there. Like I said, check with your HR department, see what your company match is. All right, and then the other thing is fees. All right, each retirement company, they offer their services and different funds at different fees. All right, some funds cost more because they're more active. All right, so they may charge more because they're looking at the investments every day. Whereas another company, hey, we may only check these investments every other week. So you're paying these different fees for how active they are, or just however much they want to charge for some reason. But fees are very important. Think of the fees as like inflation. All right, your inflation right now eats at your money that you earn every day. Same thing with these fees and your retirement accounts. All right, those fees are just like the inflation, where they're going to eat at what you could have possibly earned. So you want to look at not only how that investment may be doing, but how much are they charging the fees for this investment? All right. So if they're charging a lot more for these fees, I probably don't want to use this investment vehicle because that's earnings that I'm no longer getting. It's going in your pocket instead of mine. All right. So check out the fees to make sure that that they're in the right realm of where you're comfortable with paying. All right.
Okay. So what you can do today also is, we mentioned this, but if you're not contributing yet, you might want to at least find space in your spending plan or budget to make the match that your employer may offer as at a minimum. If you're able to do more, that can also be good. There's a lot of alternatives too that you may want to consider, like your own personal IRA. But we always think without if there's a match, that at least making the company match and contributing up to that is a really good start. So check your workplace contributions. If your salary has changed, then that number might look different now. Maybe the match has changed. There's a lot that can happen. So I think it's good every year, especially during when you're doing your open season for your benefits, to just do a quick check and see if everything looks good. At the end of the year, you might want to make sure your deductions match what you would like them to be. And if you're not really sure where to start or how to approach this, booking a session with a coach is always a really good idea. You can also consider your workplace retirement as part of your larger strategy. So we're going to talk about that next as far as creating an investment strategy.
All right. So what you want to look at is three things here. First, most important, your risk tolerance. You may be a lot more risk tolerant than I am. All right. So if you're someone who doesn't like a lot of risk, is real skittish and scared of what the market might do, then you're not going to invest the same way that the person next to you is that is fully capable of, hey, yes, I want the riskiest thing. I'm okay with that. All right. Because remember, we told you the riskier something is, more likely the higher interest you'll earn. But also, that just the opposite is true, the more interest you can lose as well. All right. So if you are not comfortable with a lot of risk, then you don't want to be in risky investments. All right. And vice versa, if you can handle a lot of risk, you don't want to be in those super safe investments. Like super safe would be like the bonds, the CDs, things that are guaranteed almost. All right. Those will be for those that are a little bit, skittish, scared, and don't want a lot of risk. All right. But just keep in mind that, like I said, with the lower the risk, the lower the rate of return you're going to get. All right. So you want a healthy mix of those. All right. But like I said, when you have a healthy mix, you want to see which one are you to determine, hey, maybe you want a little bit less, or hey, maybe you feel comfortable with a lot more risk. All right. And then the other thing is, like I mentioned before, active versus passive. All right. Active would be like maybe someone who is invested in individual stocks and just want to check and see how that stock is doing multiple times throughout the day. All right. Because, like I said, the stock price goes up and down throughout the day. All right. And that person may be a day trader or something and just wanting to check and see, hey, how's this doing? How's this doing? That's active. Whereas passive is, think of more like we talked about the mutual funds or the ETFs, where you've got lots of stocks thrown into one fund, where you don't have to really worry about all that. So you may check it once a week or once a month to see, oh, how's it doing? All right. So active, just like I said, you're real active in it, looking at it, checking it real often. Passive, hey, you put it in, back off of it, check it every now and then. All right. And then the last part there is, hey, do you want to do this yourself, or do you want to delegate, an actual professional, or get your robo? All right. So an actual professional, that would be someone that's going to be actively looking at it, hopefully, actively looking at it and making sure your account is meeting your expectations. Now you're going to pay for that as well. All right. Uh, and then where your robo advisor, think of that as maybe your target date fund that Ms. Kim was talking about, where the target date fund is you decide, hey, I'm going to retire, 20 years from now. So 20 years from now will be 2044. All right, so I would pick a fund that says, hey, target date 2044, and set it, forget it, and it automatically adjusts throughout the years until it's time to retire. All right, that would be kind of like a robo where you're not going to be really paying that much of fees because it's already set. It automatically adjusts for you. All right, so you got to think, hey, do I want something that's kind of set auto, or do I want someone that's going in, adjusting and looking at things every day? All right. So those are the three things you might want to look at when you're looking at your investment strategy.
Okay, and since we're at the hour, I'm just going to briefly share the last slide and then we will be done. So, keys to success are setting a goal. So, why are you investing? Knowing, being really clear about what the goal is for it. What's your time range? Why is it important to you? And making sure it's a SMART goal. So, it's specific, it's measurable, it's achievable, it's relevant to you, and it's timely. You have a time frame in which you'll meet that goal. SMART goals can be adjusted. Any part of them can be adjusted at any time. So we really like that for goal setting. Spell out how you'll reach the goal. That's part of the SMART goal process. How are you going to do it? Make sure that it's something that's going to work for your spending plan, for your family, and that recognizes that roadblocks do come. At Sean mentioned this, that rainy days happen. So it's really wise to consider that in your planning and give yourself grace when things don't go exactly how you planned them to go. Stick with your goal even if you change your approach. So even if your goal is pushed out by a year because something happened you didn't expect, you lost your job or somebody got sick, and you're delayed, that doesn't mean the goal has to change. The goal can still, you're still going for it. You just had to change your approach slightly. Consider dollar cost averaging. We didn't really talk about this much, but timing the market's very difficult. Some people will say it's impossible. And I think that there, even if you can, it's kind of sheer luck and maybe a little bit of know-how, but mostly it's not really a goal to achieve as far as timing the market. But time in the market is what's going to get you to where you want to be. You saw that over 200 years, the trajectory is up. So little blips come and go, but dollar cost averaging is the idea that you're not trying to put money in when things are low. You're just putting it in consistently over time, regardless of what's going on. In fact, some of the best investors set it and forget it. They're not checking their balance as much. They're putting the money in, it's going and getting invested, and it's pretty hands off for them. Make sure you're diversified. We've talked about that before, but you want to be diversified across types of assets you have: cash, bonds, stocks, other types of investments, and within those classes. So, having stocks and cash and bonds and other investments is diversified. But do you own just one stock, or do you own 20 or 30 or 50? So, make sure that you're diversified and that no matter what, you feel like you can sleep at night. Now, that doesn't mean that you don't feel a little worried when the stock market's going up and down. It just means you're not acting on those because losses are only real and when you sell. It's all on paper, so no need to worry. Write it out. For the most part, those ebbs and flows are just you want to set it and forget it. I think that's it. I know we had some questions as we were going. I think we answered everything. Are there any other questions? We'll stay on for a few minutes if there's any other questions. But we really, really appreciate you all joining us today and going over with us a little. We had some great questions we answered in the chat. If you have questions for us you'd like to ask, I urge you to either ask now or Bryant is going to send, or Sean, because I do not have access to the chat, is going to send this link that you can use to book a coach, for a session. And it's an employer benefit, so it is free to you. So we really urge you to take advantage of that. You can meet with as many coaches as you like, as often as you'd like. So if you have any questions that weren't answered today, please feel free to book with us. I think that's it, Sean. Is there anything else you wanted to add?
I would say those of you that are on our question system already, don't forget to use the resources, play around with it. Like I said, we do have simulations on there where you can put in your link your retirement accounts, your 401ks, all your different accounts. They can give you projections of how you're looking. Say, hey, I need how's it going to look 20 years out? You put in, hey, this is how I want to live. 20 years out, how am I doing? It'll give you a projection of what you need to do. Like, hey, you're on track, or hey, you need to add maybe $500 more each month. Play around with it, see how it's doing. And if you, like she said, if you got questions or need more advice on what's going, book a session and we can look at it with you.
Yeah, thanks, Sean. We did get I think a question, anything that is in traditional would count as income, and if you convert it to Roth, it counts as income. I think that this is referring to converting from a traditional to a Roth. Any portion of that would count as income in the year that it occurs. That is true. So if you have traditional, let's say a traditional 401k, and you've left the company and you transferred or did a rollover to a traditional IRA at your own brokerage, and you wanted to then convert any portion of that to a Roth IRA, that would be taxable income in the year it occurred. If that was the question, then great. If that wasn't, let me know. But yes. And Sean, I guess we can just stay on a few more minutes, and then if there's any other questions that come through. Great questions though, everybody. We appreciate those. I guess I'm answered that one. Any other questions from anybody before we end the workshop today? All right, we'll go ahead and end the workshop. Again, thank you all for joining us today, and I hope you have a great rest of your day and your week. Goodbye.
Go, everyone.